Today, we're diving into some big news for Singapore's banking sector, specifically OCBC. Analysts have recently downgraded their outlook on OCBC, and this could have major implications for investors. Let's break down what's happening and what it means for you. OCBC, Singapore's second largest bank, has been downgraded by multiple analysts ahead of their Q1 2025 earnings report. UOB Comparison maintained a hold rating, but slashed OCBC's target price from $21.10 to $16.80. DBS Group Research also maintained a hold rating while cutting OCBC's target price from $17.60 to $14.40. Most recently, CGSI International downgraded OCBC from add to hold and cut their target price to $17.20 from $19.50. So why are analysts suddenly so bearish on OCBC? There are several key factors at play. First, there's growing concern about Trump's tariffs and their impact on regional trade. Trump's reciprocal tariffs are expected to hit Asian economies hard. Vietnam could face tariffs of 46%, Thailand 36%, China 34%, and Indonesia 32%. While Singapore itself might only face a 10% baseline tariff, OCBC's regional exposure means they'd effectively face an average tariff of about 17.3%. This matters because OCBC has significant operations across Southeast Asia. The bank's regional strategy has been a key growth driver, but now that same regional exposure is becoming a liability. As Jonathan Koh from UOB Comparison put it, the slowdown in intra-regional trade triggered by reciprocal tariffs will reverberate across supply chains across the region. Many companies' China Plus One strategies are in tatters. Second, analysts are projecting weaker loan growth for OCBC. Earlier this year, OCBC itself warned that loan growth would slow in 2025, projecting mid-single-digit growth compared to the 8% they achieved in 2024. But now, UOB Comparison has lowered its forecast for OCBC's loan growth from 4.9% to just 2%. That's a significant drop that will directly impact the bank's bottom line. Third, there's concern about higher credit costs due to potential non-performing loans, particularly in the manufacturing sector across ASEAN. As manufacturers cut costs to stay viable amid trade tensions, we could see job losses and subsequent slowdowns in domestic consumption. This creates a negative feedback loop that further pressures OCBC's loan book. Fourth, OCBC is expected to see compression in its net interest margin, NIM. The bank itself projected a decline to approximately 2% in 2025 from 2.2% in 2024. Recent analyst reports suggest this compression could be even more severe, with UOB Comparison analysts expecting OCBC's NIM to drop by 7 basis points to 2.56% in Q1 alone, following a 50 basis point cut to the US Fed funds rate in late 2024. Now, let's talk about what this means for OCBC's upcoming Q1 2025 earnings report, expected to be released in the coming weeks. Analysts from UOB Comparison project OCBC's net profit at $1.87 billion for Q1, which would represent a 5% year-on-year decline, but an 11% quarter-on-quarter increase. This mixed performance reflects the challenging environment OCBC is navigating. It's worth noting that OCBC was the only major Singaporean bank to miss analysts' projections during the Q4 2024 earnings season. While DBS and UOB exceeded expectations and saw their shares hit record highs, OCBC fell short. This has created a higher bar for OCBC to clear in terms of investor expectations. However, it's not all doom and gloom for OCBC. The bank does have some positive factors working in its favor. For one, OCBC announced a $2.5 billion capital return plan in February, which includes special dividends amounting to 10% of net profit for 2024 and 2025, with the remainder allocated for share buybacks over 2 years. This plan was generally well received by analysts, with RHB calling it a welcome addition to their investment thesis for the stock. After factoring in this capital distribution, RHB raised its FY 2025 dividend per share forecast to $1.01 from $0.89 previously. CGS International analysts predict the total DPS for FY 2025 to be $1.05, in line with OCBC's target payout ratio of 60%. This translates to an attractive dividend yield of around 5.9%. OCBC also has solid asset quality and capital levels, which provides some cushion against economic headwinds. The bank's well-established franchises in key ASEAN markets and recurring revenue from core business lines should help mitigate external pressures from geopolitical uncertainties. Additionally, OCBC is well positioned to benefit from supply chain shifts and the establishment of the Johor Singapore Special Economic Zone. The bank already has 7 branches in Johor, Malaysia, and plans to add resources in Southeast Asia. OCBC CEO Helen Wong has emphasized the bank's focus on 4 growth pillars: cryptocurrency, China, ASEAN investment, and trade growth. Wealth management is another bright spot for OCBC. CGS International Analysts expect stronger wealth management income, driven by sustained improved investment sentiment amid a more stable interest rate outlook. This could help offset some of the pressure on the bank's net interest income. So what should Singaporean investors do with OCBC shares? If you're a long-term investor focused on dividends, OCBC still offers value with its projected 5.9% yield for FY 2025. The bank's strong capital position and commitment to returning excess capital to shareholders provide some downside protection. However, if you're looking for near-term capital appreciation, the outlook is less favorable. The combination of slowing loan growth, NIM compression, and regional trade tensions creates significant headwinds for OCBC's earnings growth. It's also worth considering how OCBC compares to its peers. Some analysts, like those at Maybank, prefer UOB for regional growth and larger capital returns. UOB's capital return plans offer a higher estimated yield of 6.5% versus OCBC's 5.9%, and UOB's share buybacks are expected to be 3% earnings per share accretive, compared to just 1% for OCBC. For those with a longer-term view, it's important to note that OCBC's privatization of insurer Great Eastern presents opportunities for further capital releases, though analysts caution this could take time to materialize. The key takeaway is that OCBC, like other Singapore banks, is facing a challenging environment due to global trade tensions and interest rate pressures. While the bank's strong fundamentals and capital return plan provide some support, investors should temper their expectations for earnings growth in the near term. As we await OCBC's Q1 2025 results, keep an eye on 3 key metrics: loan growth, net interest margin, and credit costs. These will be the best indicators of how well OCBC is navigating the current headwinds and whether the analysts' downgrades are justified. That's all for today's analysis. If you found this helpful, please hit that like button and subscribe for more insights on Singapore's financial markets. I'm Iggy from the Investing Iguana, and I'll see you in the next video.